Now we're going to talk about retirement plans that you can do on your own, commonly referred to IRAs. There are other ways to provide for your retirement, whether it's through 401ks that your employer offers, or if you're self-employed, there are Keogh plans, but this book will focus on IRAs and Roth IRAs. Now, currently, an IRA allows you to make pre-tax contributions, so there's a deduction on your tax return. Right on the front of the 1040, there's a deduction for contributions to IRAs. Currently, if you're under 50, you can contribute $5,500 a year. If they're over 50, then it goes up to $6,000. Now, since IRAs are deductible, we have two questions that we need to answer. Can you contribute, or can you always deduct? All right. And the answer is yes, you can always contribute. And no, you cannot always deduct it. So you may have, if you're going to stick with this IRA, you may have a deductible portion and a non-deductible portion. And the main differences are, if you just have a deductible IRA, that means everything's pre-tax. So all of your withdrawals will be taxed. Now, if you have a non-deductible IRA, you've already paid tax on your contributions. So once you start receiving distributions from that IRA, part of them will be a recovery of your investment, and part of them will be earnings. So you'll have to figure that out. Now, one of the main points, if one of the spouses does not work, we're still okay. As long as we have enough taxable income, we can have an IRA for both, the one who works and the one who doesn't. Right? And that is to allow those who choose to stay home with children, for the most part, or maybe parents, depending on what you got to take care of, still allow them to plan for their retirement as well. Now, let's talk about these limits on deductions. Because with an IRA, remember, you can always contribute. Now, a limit to the deduction applies on whether you participate in an employer-sponsored plan or not. Okay, so if we're single, we do not participate in an employer plan, there is no phase out for our deduction. Same as if we're married filing jointly and neither participate. Right? In that case, you're fine. You can always contribute and always deduct the full amount. Now, if we're single and we participate in our employer plan, once we hit $59,000, we start losing the ability to deduct, not contribute, but to deduct. And we completely lose the ability to deduct once we hit $69,000 in AGI, adjusted gross income. That doesn't look like AGI, but it is. Now, what if we're married and we both contribute? In that case, we start losing the ability to deduct at $95,000. And that one phases out over $20,000, and you lose complete ability to deduct at $115,000. Now, married filing jointly, when one does and one doesn't, or one is participating and one is not, then for the participating spouse, the phase out is still $95,000 to $115,000. For the non-participating spouse, the phase out is $178,000 to $188,000. Okay, and these are both adjusted gross income. So we have to look at adjusted gross income before this, then we figure out whether or not we get a deduction, then we get our final adjusted gross income. Now, importantly, IRAs, right? We contribute to those on a pre-tax basis. So if we wait till we're after 59 and a half, retired age as far as the IRS is concerned, we can make withdrawals right? And it's ordinary income. Okay, you've deferred all tax from the time you earned it, all the earnings, until you start withdrawing. Now, what happens if we make early withdrawals? That means we withdraw before we're 59 and a half. Well, in that case, any withdrawals are income, and generally you're subject to this 10% penalty, right? It's sort of prohibitive. Now, recently there have been exceptions that have been added, so if you are making withdrawals for special reasons, you still have to recognize as income, but you don't have to pay 10% penalties. The exceptions are for medical expenses, only those that are deductible, so that are in excess of 10% of your adjusted gross income. To buy medical insurance if you've been unemployed for 12 weeks, right? It only counts after you've been unemployed for 12 weeks. If you have a disability, right, you have a physician say that you're disabled, you can start making withdrawals. If you had inherited the IRA, right, then you can pull money out. It's not penalty. Right? Whoever owned it passed away. If you're going to pay for higher education expenses, right, that's okay. And first-time home purchase, and I think $10,000 is the limit on that as well. There are a few others that's available, but those are the main ones. The main ones are the medical insurance, higher education expenses, and first-time home, along with disability. Now, in the mid-90s, there became an option available called the Roth IRA. And Roth was the legislator who introduced this. This is similar to the IRA. Right? We still have that $5,500 limit in 2013, $11,000 if you're a couple. The difference is you're making contributions on a post-tax basis. The contributions are after tax. Okay. As such, if you wait till you retire, distributions are tax-free. Okay. So there's this difference depending on what you think your rates will be in the future, how long it's going to be. Are you willing to pay the tax now or the tax later? Now, on an expected value basis, if the tax rate now and your contributions and withdrawal are the same, then you don't care, right? It's all in the wash, right? If you expect your tax rates to be the same, you're going to invest in the same stuff. We don't care. Now, if you think your tax rates are higher now than they will be in the future, and you are able to deduct your Roth contributions, you're generally better off, you're able to deduct your IRA contributions, then you're better off with the regular IRA, the traditional IRA now. Now, if you think that in comparison to today's rates, future rates are going to be higher, right, then you are better off making your contributions to the Roth. And along with this, that's going to modify this, is do you have other retirement income options, investments that are going to be made at the same time? Maybe we're participating at our employers, so we have some retirement that's already been put away on a pre-tax basis. That's going to grow to a sizable amount. Well, in that case, we might all think, okay, we're going to have a lot of distributions there, so we might be better off with the Roth, right? Have some tax-free coming in as well. Now, again, spouses may share income for this, right? You don't have to have a job in order to take this if your spouse has taxable income. All right, so can we always contribute? Can we always deduct? Can we always contribute? No. Can we always deduct? Never. Remember, this is a post-tax item. So when we're talking about phase-outs here, it's only if you make too much money, okay? And it's only for the contribution. Right? Remember, with the IRA, we could always contribute, but we couldn't always deduct. Here, there's no deduction, but there is a limit on when you can contribute. Now, if you're single, the phase out for your actual contribution is at 112, starts at 112, and ends at 127. And this is your adjusted gross income. Right, so we have a $15,000 spread over there where we lose that $5,500 per taxpayer. Now, for married filing jointly, the phase out is over 178 to 188 AGI. So we lose it over a $10,000 range. Okay. Now, with early withdrawals from a Roth, if you're just withdrawing your contribution, there's no penalty, there's no tax. You've already paid tax on it, and as long as it's been in there for 5 years, there's no penalty for taking it out. Now, if you withdraw contributions that were made within the last 5 years, or if you withdraw earnings, you have that same 10% penalty. Right? And the other thing is, we're pulling our contributions out. All right, there's no income tax on that, just a penalty. If we're pulling earnings out, there's the penalty and income taxes, so we're sort of screwed there. Again, we have the same exceptions that we had for our regular IRAs. Now let's talk about how this phase out works. I got an example. My first example, we both participate at work. Our AGI is 110. What can they contribute and deduct for a traditional IRA, and what can they contribute for a Roth? It should be a Roth. Alright, so for the IRA. Okay, here, we both participate. The phase out starts at $95,000. Well, sorry, let's talk about our contribution. Contribution is $11,000 total. All right, $5,500 each. Two people, we're okay. All right, so that's our total contribution. Now, what do we have for a deduction? Our deduction phase out starts at $95,000. So our AGI before considering this is 110. The base is 95, and the spread is 20. So that means we're going to lose the ability to deduct 15 over 20, or 75% of our allowable contribution. So if we make that full contribution and we lose 3/4 of it, that means we lose $82.50. Right. So here's our contribution is $11,000. Our deduction then is the difference between the $11,000 and the $82.50, which is $27.50. Okay. So let me partition this off so we know what we're doing here. Now with the Roth, the question is, can we contribute? Right? If we look, our AGI is 110. The phase out starts at 178. Contribution then is 11,000. Okay. Now, does anything change if our AGI is 185? So if we're going to look at the IRA, here our contribution, remember you can always contribute to a Roth, but can we deduct? AGI is 185. We both participate. The limit on that is 115. Right? So in that case, our deduction is 0. That one's easy. Now, let's look at the Roth. Here, the question is, can we contribute? We know our AGI is 185. That's in between our phase out, which begins at 178. Right? And has a $10,000 spread. So we're going to lose 7 over 10, or 70% of our possible contribution. So look, maximum contribution would be 11. We lost 70% of that. So we can contribute 30% of the 11, which is $3,300. That is your contribution to your Roth.